I'm going to talk about the concept of carried interest in the world of venture capital. Now, carried interest can mean different things to different people in the world of finance. We also use the concept of carried interest in oil and gas sector, which has a completely different connotation to the concept of carried interest when we talk about venture capital. Today, I'm going to talk about venture capital. Before I delve into what is carried interest for a venture capital, you need to know about two different terms, the LPs and the GPs. LP means limited partner and GP means general partner. In venture capital, limited partners are the people or institutions which invest their money into the venture capital. The money that goes into that venture capital, that investment, is managed by general partners. So general partners manage the money on behalf of the limited partners. Limited partners could be high net worth individuals or institutions like pension fund or endowment or foundations, etc. So when the general partner manages this money on behalf of the limited partner, they do not do it for free. They get some reward, and that reward comes in two forms. They get to take management fee for operating that fund on a day-to-day basis. And secondly, when that fund makes some profit, then they get to keep a portion of that profit for themselves. That is called carried interest. Now I'll show you with the help of a simple example. Let us say a limited partner A puts $10 million into a venture capital fund X. That venture capital fund X is managed by a GP or general partner. That GP puts that $10 million into a startup, let's call it startup ABC, which is valued at, let's say, $50 million. So this fund X, which is managed by general partner, puts all this money of $10 million into a startup, and it takes a stake of 20% into that startup. So it gives $10 million to a startup X in lieu of getting 20% interest in that startup. After a few years, that startup grows to become, let's say, a billion-dollar company or $1,000 million. Once that stage is reached, then a general partner will sell its stakes into that startup, and it will get back money equivalent to 20% of the valuation. So if the startup at that point, after a few years, is valued at, let's say, $1 billion, the venture capital fund X will receive $200 million for selling its stake. And the fund X will get back $200 million. Now at this point, general partner will tell the limited partner, look, you gave me $10 million and I converted that $10 million into $200 million. So I have made a profit of $190 million for you. And not talking about the management fee, I have a carried interest in that profit of 20%. So of that $190 million of profit, general partner would be owed 20% of that $190 million, which equates to $38 million. So the general partner or the venture capital will keep aside $38 million for itself and give back $162 million back to the limited partner. Now I've simplified it to a very large extent. I haven't talked about management fee and few other things which would make this math a little bit more complicated. But just to keep it simple, just to give you a flavor of what carried interest is. So in this example, limited partner invested $10 million, the fund generated $200 million, the profit was $190 million. So the general partner got a carried interest of $38 million and the limited partner received $162 million in return. That is the whole concept of carried interest. In the world of oil and gas, this means a completely different thing, which I'll talk in a different video. I hope you like this, and as usual, I'd like to get your feedback. Thank you very much.